Welcome back to the Capital Mindset Podcast, everyone. On today's episode, we're going to be discussing return of capital, specifically around dividends and buybacks. And today, I hope to make actually the case why dividends in a lot of ways are superior to buybacks. And I know this is going to be very controversial, but we'll go over all the arguments and I'll lay it out for you, hopefully in a simple way. Now, there's going to be one caveat. There is one type of buyback that is far superior to that of dividends, but we'll get to that. Okay, so before we begin, let us discuss what is return of capital. A return of capital to shareholders happens after, let's say, the business makes extra money or is profitable and is looking to reward its shareholders in some capacity, and it's looking around and doesn't see many other investment projects that it could undergo to generate more rates of return. So when you're looking at a business, you should be looking at it from this perspective. Is it investing into projects that are yielding a higher return than I could otherwise do on my own? Well, if the answer is, let's say that you could return something greater than the business is internally, you would want some form of return of capital. Now, the problem with this is, and we'll get to this with the buybacks, is that alone is very problematic in that line of thinking, but that's a general line of thinking you should employ. Okay, so let's begin by saying, as an example, let's say the business is returning a rate of 8% every time it invests $1. So every dollar it invests, it returns $1.08. But you are some really good investor, or you have opportunities, let's say in your life, that you could, invest $1 and return, let's go extreme, $1.50 each time you do that. Well, then in your case, you want that business that you own to return capital to you in some capacity. Well, let's begin with a buyback. Well, a buyback simply grabs money from the business and buys shares, and tomorrow you'll own more percentage of the business than you did today. Well, if you are that investor with other opportunities to invest, this actually doesn't benefit you from the get-go because you have to sell shares in order to actually get that. And investors will say, well, a dividend is the same thing, right? You're just getting money out of the investment, and in effect, it should be equal to the other. We'll go over later why that's not true and why that can't be true, by the way, even from first order principles in business. So when we do a buyback, I will start by saying a well-executed buyback. Keyword, a well-executed buyback is superior to that of a dividend. No ifs, ands, or buts. And what is a well-executed buyback? Well, the thing is, it's hard to say what is a well-executed buyback because a buyback is subject to volatility. Very important concept. Very, very important. A buyback is subject to volatility. What do I mean by that? Well, we look at the market and we say, okay, we see the stock price go up and down, various things happen. This is what I'm referring to by volatility. The price is changing, price fluctuations, etc. Well, in the private markets, we can buy out another shareholder. A shareholder can say, I want to leave, and we can negotiate on a price and a fixed price, and we can do that. You can see that in the public markets too. In fact, we see that recently with Tencent and Ubisoft. Tencent agreed to buy shares from an Ubisoft shareholder, the founding family specifically, at an agreed upon price. So we can in fact see that in the public markets. It is a bit rarer though. Usually we'll see that they'll buy it on the open market. So a well-executed buyback is superior than that of a dividend. So if you are buying back shares at good prices, then that is superior to that of a dividend. But a dividend avoids the volatility factor because it's cash that is deployed into your pocket. So where do the buyback enthusiasts go against the dividends? Well, a buyback enthusiast or a dividend hater, let's call them, just to be funny, let's call them dividend haters. A dividend hater will say, well, a dividend, it's basically removing money from the equity portion of the balance sheet and putting it into your pocket. Also, the cash portion, because of how the balance sheet relates. Just a quick synopsis. Assets equals liabilities plus equity. So when we remove the portion of the equity portion of the balance sheet, we're also subsequently removing a portion of the assets, basically the cash that we use to pay the dividend. So it's equal. And then in the case of a buyback, we are simply, again, doing the same thing, but we're more tax efficient. So first we'll begin by attacking this notion, the tax efficiency. While this is true, it is more so true for high net worth, high income individuals. You should look and talk to your tax professional that knows your situation in your nation. But for the United States in general, again, go look into this. See what amounts of dividend income you would have to generate, what tax brackets you'd have to be in before you even start paying a penny in dividend taxes. Also caution the entity that we're talking about. Remember, qualified dividends is the key word here. Qualified dividends. There are unqualified dividends as well out there in the world. You can look at structures like a REIT or an MLP for further guidance on that or further nuance on that. Now, a dividend, again, removes that volatility factor. Okay, so when I get paid a dividend, I don't have to worry that what's the stock market doing today or tomorrow? Did the management do it at a good price, bad price? I don't have to worry about any of that. But again, a well-executed buyback is superior to that of a dividend. No question about that. Now, dividends are still technically at large scale tax inefficient when compared to a buyback, even when the buyback tax goes into play next year. We'll see what companies do to adapt to that or how their behavior changes. But all in all, why would a dividend be superior? Well, let's explore that a bit. Okay, again, the argument that a buyback person would say, or someone who says buybacks are always better, is that perhaps you could say it's the same thing. It's equivalent to dividend is just like selling off parts of your stock, which I don't agree with entirely. Okay, I don't agree with. I think that's absolutely wrong. It is incorrect. Okay, and let me explain why. Well, that assumes, right? Because what are we getting with the dividend? We're getting cash. Well, cash is an asset. They're right. It's like getting assets out of the business. They're absolutely right. Okay. And they'll point to the change of a price of a stock when it pays a dividend. No, that's because that's a closure in arbitrage. As markets have become further and further efficient, more and more information, faster response times, all that arbitrage has been closed over time. So now the markets reflect arbitrage, or the arbitrage that used to be there once upon a time is basically closed. So you see the fluctuations in price on the ex-dividend date, etc. That is not because the market is therefore saying the company is now less valuable because they paid it. No. Because plenty of times you can see that the stock price will recover the next day or it falls the next day. It's not related. Okay, it's just the closure of arbitrage, first of all. Now let's discuss the problems with saying that cash leaving the business is the same as selling shares of the stock. No, because that is now assuming that cash as an asset is the same as all other forms of assets on the balance sheet. Well, we know that's not true. We know that's not true. If I look at a business that has all cash on the balance sheet, all cash, that's its only asset, that is so vastly different from, I'm going to go extreme and say Berkshire Hathaway. That is so extreme. That would be like saying a bank account is the same as a business. No, it's not. A checking account is not like a business. One is cash, one is a pile of cash, and the other one has a whole host of productive assets that generate cash. They generate form of return in the future. Okay, so let's kind of explore this a bit, right? If a dividend is just the same thing as me selling shares, then those other things should basically be the same thing, right? Because a dividend is not forcing me to sell an asset, because an asset has a present value, right, that we could kind of estimate that reflects all the future cash it will generate into the future. Okay, when you sell shares of that, you are not getting cash. Cash has a PV value of, or PV factor of 1. It doesn't exist. We don't discount it. We don't discount cash. We do not do that. Now, I have said in the past that there are certain entities that we should discount cash. We're not getting into that rabbit hole. That is not a rabbit hole we're going down. We're sticking to simple things. We're sticking to just U.S. companies, regular C Corp entities. Okay, in these instances, we do not discount the cash. The cash on the balance sheet is as liquid as it gets, and we can access it today, and we can get it in the form of a dividend, and that is valued at $1. We don't discount it. So that is a value of 1 to 1. An asset, no. We look at an asset and we can derive a value present upon or predicated upon the future value it will generate. So when I sell shares of this asset, right, I am giving up all that future return, all that future potential return when I sell shares. When I receive a dividend, I'm giving up none of that. I am receiving cash. Cash is an asset, yes, but assets are not equal to other assets. If that is the case, then we could jump and follow the same logic train and say a business that is full of cash and nothing else is the same as Berkshire Hathaway with all the stocks that it owns and all of the jazz. No, 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 no. That is not the case. The reason why Berkshire Hathaway shouldn't be paying a dividend right now is because it presumably has investments that it can make internally that are superior to that of giving cash to the shareholder. And as a shareholder, if you are thinking about the longer term value perspective or longer term value proposition, right now, Berkshire is not in that position to do so. It's not. And this is to go back against people who say that a company that doesn't pay a dividend has no value. That is also false. And let me explain why. Really, in all honesty, when we go to the first principles of business, the first principles of investing, it's about ownership. It is about evaluating the future return potential of a business. If a business will never return capital to you, it is actually worthless. I agree with that. Now, let me say that again. A business that you own, and let's assume that we somehow know, okay, this is the key word, we somehow know it will never, ever give you a penny, it is worthless. It is almost, its only value will be derived from how much you could sell it to the next sucker who will get those shares and pay you cash for it. That's it. It will be based off sentiment. Now, when we look at a company like Google, and I've said this in videos in the past, by the way, so this is now just in podcast form. We look at Google. Google doesn't pay dividend. And for a long time, Google didn't return capital to shareholders. So why was it valuable? Well, because we don't actually know that it won't do so. And there's always the potential. So we ascribe value to that. And as it increases its future potential of return to capital, then its value should rise. Okay, because in the future, if I bought it, let's say at a $10 billion market cap, and today, or I thought maybe in the future, it could return tens of billions of dollars. That has incredible amounts of value to me as a shareholder. Of course, I don't know that it's going to be able to do that, but in doing so, in increasing its net income and increasing its cash flows every year, year in and year out, year in and year out, it is improving the prospects that I can get some form of return of capital to me, the shareholder. Okay, so that's in the direction we're going. And even though right now it doesn't pay a dividend, even though right now, and I'm not saying right now in a literal sense, I'm talking about in the past, even though at that time it didn't pay dividend, even though at that time it didn't buy back shares or it was diluting me, I knew that the future potential was there, that it could do so one day at a greater proportion. So as an investor, I'm willing to stomach that. But if you know there's an entity that will not do that, and somehow you know that, then it is actually fundamentally worthless. Yes, and this is true in the private sector and in the public sector. If you think so, if you don't think that's the case, then I have a proposition for you. Let's start a business. You invest in my business. I will never give you a penny. You will not invest in that business. And if you do, you are a fool. There's no other way around it. You are a fool. And if I told you that I would never give you a penny and you invested in my business and you get this little certificate that you own shares in my business and you can show it off to your friends, but you also know, because I was upfront with you, that I would not return a single penny to you, okay? You would be a fool to buy that business. Absolute fool. Okay, you would only buy it if you thought, if you don't have that realization that I will never return capital to you. Okay, but if I am, a standard business, your regular business, you own shares in me, and then I'm doing the regular course of business activities, and I'm generating more and more net income, if I'm not giving you anything right now, that doesn't mean that your shares are worthless. No. Because the potential, the future potential has value. So I don't give anything to you today, but I could give you something maybe in 10 years from now, and maybe in 10 years from now, it's orders of magnitude larger. And so basically, let's say I issue a dividend in 10 years from now, and it's equivalent, or maybe it's twice as large or 3 times as large as what your initial investment even was. There are a lot of stocks, by the way, that are like that for those OG investors. So that's the basic principles of where the value of a business is derived from. And it's very important to understand that. Everything comes to the return of capital. If a company never returns capital to you, it is worthless, period. But companies that currently don't return capital to you, it's not that they are worthless at all. No, it's because they have the future potential, and it is unknown for certain whether or not they will or will not. But we presume that they will because you own them. Okay, that's the other thing. Now you can kind of get an idea of why, if you follow these first principles of investing in business, you can't feasibly invest in Chinese VIEs, which we won't get into in this video. We will not get into them. But going back to dividends, when I elect to get a dividend from my business, I am not having to sell the shares. Now, this is like, let's say, it's somewhat equivalent to this, okay? So let's say you and I, we own private shares of a business, all right? We're sharing ownership in Capital Mindset, right? And you're a fellow shareholder and I'm a fellow shareholder. And you want to get some form of money, but we choose not to pay a dividend. But you're going to decide to sell your shares to a third party. And you're going to find, I don't know, your friend. And your friend will buy the shares off of you and he'll give you cash. What are you giving up? Capital Mindset has cash on the balance sheet, right? We have cash. You're not giving up that cash, right? You're giving up all the future return potential that your percent ownership had in the business, and you're giving it to your friend for cash today. But is the business really worth the cash today? Well, that's a question. I don't know. What is all the future potential earnings of Capital Mindset? So you're making that choice. You're electing to do so. And on top of that, let's say for a retirement plan perspective, when you do that strategy, when your strategy is predicated on selling to someone, what have you just opened yourself up to? We get back to that first concept we began this episode with. You've subjected yourself to volatility. Now, you better hope that the time you're deciding to sell your shares, you better hope that it's a good time. You better hope that the market is maybe in exuberance and not in the midst of a recession, not in the midst of a bear market. Because now if your retirement falls on that calendar point of the cycle, well, now you are in trouble, my friend, okay? Because now you can't get the best retirement, or you're going to probably get a worse retirement than had you retired a year before. This is where I understand and very much sympathize with the dividend and growth investing crowd, the dividend growth investing community. I just have an issue also on top of that. Try to be diplomatic here with both sides. I think that there's a problem with focusing solely on dividends. But I hope to have explained in order in this video why return of capital to shareholders is, in essence, the true value of a business. And we don't discount, or we don't say a business has no value if it's not returning capital today, because it is essentially growing its potential that it will do so in the future. And of course, as an investor, you judge that and you say, okay, is it investing back into the business, and is that growing that future potential? Because one day it will slow down. We all know that. One day businesses mature. If you were an early investor in McDonald's and you were buying the shares and you saw that McDonald's was opening a new location, a new location, a new location, and each time they did so, it was returning a huge percentage return to each dollar invested, you would say, McDonald's, don't pay me a dividend. You are still in your growth phase. Don't do buybacks. You're still in your growth phase. Keep grabbing those dollars and shove them into new locations. Keep growing. Keep buying new locations. Keep expanding the business, because that's the most efficient use of capital. Then when you're matured, and then when your return potential goes down, then you start to make those judgment calls. Let's return some capital to shareholders. Let's reward those investors now, because that's now how we can show them the value of all their investments they've made over the years. And if they choose to sell, they have to know what they're giving up there. They're giving up all the future returns that the assets under McDonald's will generate into the future. So, and again, we got into like the whole retirement discussion. If you are retiring and you're relying on that strategy of, okay, I'm going to sell my shares at a higher price because it's the same thing. Well, now you must understand what you've subjected yourself to in principle is you've subjected yourself to volatility. You are now beholden to volatility. You are now beholden to whatever the prices are when you decide to sell. That they might be good prices. They might be bad prices. Who knows? Who the heck knows? And so when I think it becomes very apparent when you start to talk to people, let's say, who are, in the business class. They have their own business and they understand this very easily. I find this sometimes hard to discuss with retail investors. It's something easy when you have a business and you can understand, you can grapple with this, and you say, well, you're not obviously selling shares of your private business. That would be silly, right? Go start a private business and then start, thinking in this way, like, oh, every time you want cash paid to you, you start selling off shares. You start selling off. No. You're probably going to look at it as, I want to keep ownership in my business. I want to own, let's say, the whole business or most of the business or whatever portion. You want to keep your shares, and then you want to reward yourself with some of the cash that's extra, that's laying around. And you're like, okay, I don't need this cash to grow the business and make more money tomorrow. I can grab this cash and just put it in my pocket and spend it, etc. And so I hope that I've made the case clear. I can kind of expand on it further, but you cannot equate cash as an asset to assets that generate cash into the future at an unknown value or an unknown rate. Okay, that's not the same thing. When you sell shares, you are not just giving up the cash pile, you are giving up all the assets, all the patents they might have, the property, plant, and equipment, the land, the buildings. You're giving up all of that, okay? And you're giving it to someone else, and you're receiving cash as compensation. But all those assets, they're productive assets. You're exchanging a productive asset for a non-productive asset. In return, a dividend is just a company giving you its non-productive assets. That's all it's doing. It's saying, I have this non-productive asset. It's called cash. It's a non-productive asset. I don't need this cash. I'm not going to sell my property, plant, equipment. I'm going to keep that because that's going to generate us more cash. But I'm going to give you this non-productive asset today so you, as a shareholder, you can go spend this. You can do whatever you want with this. You can choose to buy more shares of us, or you can go, enjoy your lifestyle. All right, do whatever you want. Here's the cash. Boom. Now, I love, personally, I'm going to talk now a little bit about what I love, and then I'll close off the podcast. What I love in a business is one that mixes the two. One that says, I not only will pay dividends to the shareholders when the time is right, by the way, because that's another problem with American companies sometimes, is that they get caught up in this always, no matter what, pay a dividend regardless of anything, which I don't really like. I like more opportunistic. And opportunistic buybacks. I love that. If I see a business like that, oh, amazing. Chef's kiss right there. And you'll see this more in businesses you can control. Let's say private businesses, you have a shareholder that, wants out, and then you're like, oh, I'll buy back the shares. I'll buy up the shares from you as a business. The business will buy up the shares. And then that comes out of, your portion of equity. They're getting the cash, and that's how you close it. We won't get into the accounting of it, but basically you can close it off, or you pay from your own pocket the shares, and you buy up all the shares. You could either delete the shares or you just buy their shares. One or the other is probably what you're going to elect to do. Point is, I love a business. If I find a business that is doing opportunistic buybacks, and when it has extra cash that it doesn't really need, can offer a dividend, amazing, amazing. There are a lot of businesses like this. And right now there's a lot of businesses that are electing to do buybacks, perhaps irresponsibly. Right now, I think it's a little bit taboo to say that, let's say Apple is doing irresponsible buybacks, but I'll say it. Apple's doing irresponsible buybacks, and they might live to regret it. I would prefer, if I was Apple, if I was somehow in charge and given that authority, I would pile up the cash and wait on it. And just wait on it. And you think the market actually really values the cash? There should be a rude awakening. I hope that all of you who have been following the channel for a long time, or have been at least investing for greater than a year now, have seen this. No, that is not the case. We have seen plenty of businesses that have been destroyed by the market, and they have crazy amounts of cash. The market does not give two S's or two F's about that cash pile. I've shown you guys case studies of micro caps, and of course with caveats on them, but micro caps with boatloads of cash, and the market doesn't really care. And I'm talking boatloads of cash and no debt. The market doesn't really care. So are those opportunities or something else afoot? Well, the point is, it's more nuanced than that. That's the actual point. It's more nuanced than that. At any given time, the market can do whatever. The market literally is unpredictable in that way in the short term. It's very unpredictable. And I hope that you guys have been seeing this with sentiment. We have been buying stocks that, the sentiment is absolutely wild, how it changes from 1 month to the next. 1 year ago, see how you can see how short-minded investors are, really. And each time I say, okay, I'm not going to be surprised next time. I expect that. No, I'm always surprised. And then people are always surprised or find it, fascinating that someone can buy a stock when it's absolutely hated, but you actually do the due diligence and it's not a value trap, and you actually generate crazy returns from it. And then people go like, well, everyone knew that. It's like, okay, well, you just forgot that everyone hated it at the time that, we were buying. But anyways, it's neither here or there. It's just a little bit of a rant towards the end. Point is, you can see, I hope I've laid out the argument why actually dividends are superior to the strategy of finding a ways to sell your shares. It's not. And if you have a dividend paying stock, or companies paying you dividends in your Roth IRA, you have the perfect setup. I'll tell you that right now. That is the goal, in my opinion. For me, I want to have my Roth, and right now I'm having to do in the future like a backdoor Roth, etc. But what I think the average American should aspire to do is high quality dividend paying stocks or some form of or another in the Roth IRA or Roth 401k. That is magical. Okay, you can't beat that. And of course, some dividend stocks are better than others. So that's why I said the asterisk on there is good dividend paying stocks. Apple's one, by the way. Microsoft's paying a dividend. All these businesses, they're now entering their more mature phase. And even though in their mature phase, they look really good. They're still growing. It's not like, these are non-growing companies. Apple's kind of plateauing, but Microsoft's been growing nicely. So anyways, I'll leave you guys off with that. Hopefully I laid out the discussion there. We can continue the discussion either here here on the platform on Substack. By the way, you guys can leave comments on Substack, or you can find me on Discord. I still have to make a video on how to get into the Discord because I know it's a black box. Actually, I'll get onto that after I finish this recording. But if you're watching me on YouTube, you can also comment down below, or if you're watching me on Spotify, I don't think there's a way you can comment on Spotify. But with that being said, guys, thank you guys so much for tuning in, and I'll see you guys on the next one.